TD Ameritrade released the IMX data for April showing that clients dialed back equity exposure, about 20 bip drop. The reason we pay attention to this, it's not anticipatory data. It's what their clients are actually trading out of 6 million actively traded accounts. What's interesting is, and it kind of correlates to what you've been doing in the portfolio, dialing back those high beta momentum names and looking at better quality dividend paying names.
Yes, and we have been seeing this big rotation away from momentum and high growth stocks into value and what I would call nifty 50. The companies that are just blue chip, great balance sheets with a great valuation, a cheaper valuation, and dividends, either growing dividends or just higher dividends. And it's been interesting, Jill, to note that it's been utilities and telecom that have actually led the way, and some energy as well. But it's also a broader base of the names that you're talking about too, in terms of what they're buying, and it really has a defensive tone towards it.
Well, that's indicative of the market overall. We're seeing the S&P and Dow Jones names, they're doing okay. NASDAQ index, it can't get out of its own way. And it's interesting because the momentum traders that couldn't value these companies high enough, you're finding no support in them. There is nobody coming up to swoop up what you would think like a FireEye, for example, would be really cheap at this point. No one's coming in to buy that. Twitter certainly can't get out of its own way with the lockup over, but you're seeing more buying in your Amazons, your Facebooks, your Googles, your Disneys and Starbucks and services for that matter.
Which is kind of interesting. So I think at the end of the day, it's really a stock picker's market, right? And those companies that have a good business model. So I think that there's a big difference between a Facebook and kind of a FireEye, if you will. And I think there was a big difference between the earnings. Even a ServiceNow, which is a name that we actually recently sold, they didn't make money in the quarter, but they had phenomenal growth. They had 60 to 70% earnings, revenue and earnings and billings growth. But people aren't paying for that company that is investing heavily to get that growth right now. So I think you really have to be very selective. And we've raised a little bit of cash, and we've been putting to work into some higher quality names, like a United Technologies, for an example, or a 3M. But that said, we also took profits in Chevron. You know, so I think it's very important to take profits when you have them. I do think there's definitely a defensive tone in the market right now, and we're going to see. We have a lot of cash, and we'll see what develops to be buying some more.
Well, you know, it does make the job a little bit more difficult, but it makes it more interesting too, because in 2013 we saw these extreme V bounces in the market. We're not getting that anymore, so I think it's really going to be the time to shine, to pick your stocks, pick your sectors, and it's great for stock pickers like us.
Absolutely, and I also think that it's interesting to note that it's been the laggards that are doing pretty well this year. Industrials, for example, they're catching a bid. Energy, as I mentioned, are catching a bid. It will be interesting to see if financials finally can catch a bid. I think you do need interest rates to go in the other direction in terms of the bond yields. You need a steeper yield curve for that to happen. But I think kind of the froth has been taken out of that group, and it will be interesting to see going forward if it can play catch up.
Okay, all right. Thanks, Stephanie.
Thanks.